Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Mike McGlone, Macro Strategist at Bloomberg Intelligence. Welcome back, Mike.
Thanks for having me back. I haven't.
Yeah, it's been an absolute pleasure. So, Mike, Credit Suisse default swaps have hit new all-time highs, and insurance to protect against these default on their bonds is absolutely out of control. What does this tell you?
Credit Suisse is a bit of a one-off for European banks. But what I've heard from some of my colleagues, one particular colleague, our senior interest rate strategist, Ira Jersey, used to left there, is their management has issues. Unlike what's happening, but the key thing, you're seeing what you would expect from the Swiss
Right.
National Bank. They're providing liquidity to support the system. But the bottom line for, I think, with Credit Suisse and the banking crisis, which is clearly global now, is particularly in the US, is I think it's just trees in the massive ebbing tide forest that's just getting started. The one thing that has all the banks in the US have in common is they had too much duration in the reserves, and they're having to liquidate some of those because people are pulling deposits to go to U.S. Treasuries. And as Jim Bianco says, that 2 note getting to 5% was my trigger. Like, what rational human being on the planet is not buying a 2 note you can guarantee 10% return in 2 years? And to me, that's part of what's happening. The Fed is clearly breaking things. The ECB has just hiked rates, and the Federal Reserve is expected to hike rates.
Yeah, that's bad. Like, how trapped is Powell right now between fighting inflation?
Not at all.
Yeah, like you don't think he's trapped?
Not at all. Just stop hiking. What's right now, we're within a day of the 1 year anniversary of the first Fed hike, the largest, the most significant, aggressive global central bank hiking period ever,
Hmm.
the most rapid hiking from zero ever. And we've basically gone from zero to almost 500 basis points in less than a year. And it's the rule of long and variable legs are just starting to kick in. So he's not stuck at all. Just stop hiking rates,
Yeah.
because if he does, which he still might, people are going to look back at him. Well, thank you for causing the Great Depression, sir. At least he can go back and say, well, I stopped when it was clear. So all my indicators are, we are heading to a severe economic contraction. Not just the yield curve, not just housing, not just commodities, but this fallacy that central banks are looking at 12-year measures of inflation and still hiking rates and
Yeah.
thinking, oh, do we have to? If you hike rates now, maybe you will feel that effect in a year. So my point is, come a year from now, come July, Ivan, we're going to see clear signs of deflation in the headline inflation measures. And I can start with PPI, I can dig into that a little bit. But right now, all my leading indicators, when you manage and you're strategist, and I used to run money with clients, is
Hmm.
you look forward. Those forward indicators, looking through that front view mirror, is we are heading to a severe, serious economic hard stop. And hiking rates is basically right now an oxymoron in this environment, particularly with the banking crisis, commodities collapsing, and like you mentioned, what's happening with Swiss National Bank. I'm sorry, with Credit Suisse, to see the ECB hike rates 50 basis points. I'm like, yeah, that's just so seriously academic. When you're
Right.
a trader and you sit at a desk, I remember being a trader, sometimes economists would come out and say something, and it's like, yeah, great, thank you. I'm doing the opposite because what you just said is priced in.
Right. You said earlier too that you want to dig into PPI.
Yeah.
Let's dig into that. What is that indicator telling you?
The producer price index on when it comes out on July 13th will be the measure for June. I fully expect that year-over-year measure will be negative. The most
Hmm.
significant negative, because of plunging commodities, producer prices have a very high correlation to commodities. And by the way, producer price index has an 80% correlation with this consumer price index, the CPI, and then of course all the other measures that are so lagging and so dig into the details. The macro is crude oil peaked in June of last year. The actual index, the year-over-year the actual producer price index peaked in June. And right now, as the current measure, the latest measure is 8 months from there, it's down 0.5%. So we are seeing deflation on a 8-month basis from a producer price index. And you look at the Bloomberg Commodity Index, it's down 20%. And I'll just
Wow.
give you a historical example. And I've been publishing on this. I published on it twice now. The last time PPI printed, and when it just printed again this latest week is,
Hmm.
and the data started getting more and more bearish. And the key thing is to remember is the most negative year-over-year measure ever was minus 6.9% in July of 2009, because it measured from July of 2008, which is when crude oil peaked. Guess when crude oil peaked? Just about June of last year. It was
Yeah.
got as high as 130 last year, and right now we're speaking, it's at $66 a barrel. That's what we predicted. I was way too early. I was wrong, but then it worked out. It's coming that way now, and to me, that's the facts of what's happening. It's not just an isolation. It's, you look at housing. It's the most significant correction, downturn coming I've ever seen. You look at the
Hmm.
housing affordable index. You look at mortgage interest rates. Key things like housing under construction divided by sales. It's worse than I've seen in the 70s and in the 2006. So it's all getting started. And then when we have to still consider the ECB is still hiking rates and the Fed might be hiking rates, it's
Hmm.
seriously silly mistakes that are going to go down in history, I think, as some of the worst examples of monetary policy from a rear view mirror, when you should be looking in the front view mirror. And one thing to remember is that the Fed had a lot to do with the inflation we have. Remember, they spiked. It really created a lot of liquidity that's
Right.
going away rapidly. Now, in their defense, we were in a pretty severe global plague, and then, it's only been almost 2 years. We've had vaccines. Now we're back to normal, but that pump in liquidity is dumping faster than it pumped on a global basis, most notably watching things like US money supply. Just be able to say things like, a couple of years ago it was the highest ever on a year over year
Right.
basis, and right now it's the lowest ever, and the first time negative when you go back 60 years. Being able to say something like that, you have to expect reciprocal actions in markets, and I think you're seeing in commodities. The key thing is the stock market's just starting to break a little bit, and bond yields are starting to break hard. You got that 2-year note that was at 5% right now. It's just a week and a half ago, it's now 387. This to me is an example of up on the escalator, down in the elevator, getting started. And typically at this stage, with the forward-looking indicators, the
Hmm.
Fed would be easing aggressively, and they're still tightening. So to me, this is an example of happening so fast, going back down. Now, I don't see how we're going to get out of it, but the key thing I see benefiting from all this is gold.
Right.
Markets that will most likely go higher: gold, U.S. Treasury long bonds, and Bitcoin, and silver's kind of stuck in the middle there.
Do you think now that everything's all these banks are starting to get either regulated, shut down, a lot of people are going to start switching their savings into gold? Like, what do you think,
Oh
Mike,
yeah.
personally?
Oh, clear. Well, the banks have. So we've had
Right.
some of the biggest gold buying ever from some of the major suspects, China and Russia, and maybe some other ones. And I don't see why that should stop, particularly because of safe haven assets. So U.S.
Right.
Treasuries still, I think, are very attractive. The key thing is the U.S. banks have a major problem. They have most of the reserves in safe U.S. securities, but they had too much duration, and we just went through the worst bond market collapse ever. If you have to, I mean, some data goes back to 1871 on that. I think that's a buying opportunity, but in the meantime, it doesn't matter. When you can get zero on your bank account, yet you can go buy a money market or just a T-bill and get
Hmm.
5% or almost 5%. That's just no. Banks got to catch up to that, which means it's going to be bad for earnings. But this right now, I think, even is at the point it's unstoppable. Basically, as my colleague Gina Martin Adams said, who's been somewhat bullish on equities until recently, pointed out that the Fed needs to be the savior in this environment, and they're still hiking rates. So
Hmm.
they're still looking to. So that to me is the lose-lose I see at this stage. Is you have to ask yourself, what stops this? I've been asking that question too long now. What stops this trajectory of deflating assets, deflating stock market, deflating housing, deflation?
Hmm.
And typically it's the Fed still looking at, CPI number was too high. Like, excuse me, but that's a 12-month measure that's completely lagging. Have you noticed housing prices dropped? What is it, total $2 trillion
Yeah,
last
it's
year or
crazy.
something?
It is absolutely crazy. And Mike,
So that,
people,
yeah,
people,
go ahead.
sorry to cut you off. People are saying
No, no.
what we are witnessing in real time is like Lehman 2.0. Is it that bad or no?
So Lehman 2.0 was a one-off, but I think it's part of the key thing. Remember, it was kind of started with Bear Stearns.
Right.
Lehman was, but no, take that back. It wasn't a one-off. It was part of the ebbing tide. Lehman would have probably never happened in an extended period if we didn't have all risk assets going down and housing going down and CDS blowing up. Just like, why did FTX collapse recently? If the crypto
Right.
market didn't drop 80%, we probably would have never, they might have gotten out of that eventually. And it's good that we finally can get rid of some of the weak players because it makes markets stronger. Unfortunately, if it doesn't kill you, it makes you
Hmm.
stronger, as Nietzsche said. But I don't really. I think this is worse in a macro picture because I think we're heading for the greatest global macroeconomic reset of our lifetimes. Just the biggest, on the back of the biggest pump in liquidity that's dumping, and every single big boom has come on the back of liquidity, and then the busts come on the back of taking that liquidity away. And you can go back to South Sea bubbles and bicycle manufacturers in the 1890s in England. It's just
Hmm.
happening in a big way. And that's the key thing I like to point out is every single bank had one key, in the US is one key issue here. Declining reserves are supposed to be safe, but the duration was overextended, didn't hedge properly. It's really hard to hedge sometimes properly. I mean, I used to do that for a living in the trading pits. And deposits that are leaving for safer, good old T-bills, 5%, almost. It's kind of coming back now.
Now you see everything happening with Credit Suisse and even Silicon Valley Bank and even Signature Bank. Can they keep this under control, or are we going to start seeing in the next 2, 3 months a bank after another bank start? What do you think, Mike? Can they contain it, or will it just go out of control like a fire?
Typically, the way you contain things like this is you throw massive liquidity at it.
Mm,
Fed easing, and now we're actually they're showing up the depositors, the banks, but that's what's missing. It's just kind of, and I do not want to be a fearmonger, but I have to point out, as a person in my position, if I don't warn people like you and our viewers and listeners that I see a hurricane
right,
coming, I'm remiss. So that's what I'm doing. And to me, this is, you're seeing the one-off saving, but you need to see the forest save. Those are trees, and the trees are just getting started based on, remember, this is only the 1 year anniversary.
right,
Long and variable lags to monetary policy. It's just starting to turn over. So at this point next year, I fully expect we're going to be talking about severe deflationary recession and how much is the Fed going to ease to help us. And so within the next 3 months, I don't know. What's the next shoes to drop? I don't know. But I like to clearly point out
hmm,
these are trees. Some of them are improperly mismanaged. Stronger will survive, but the whole system's going down hard. It's not profound to say that, it's factual. I show the
right.
housing market speaking from the highest level ever. I show the commodity market peaking from near the highest level ever on a relative basis. If you use like 60-month and 120-month moving average, the stock market, the U.S. stock market was a few months ago the highest ever versus GDP, the highest ever versus global equities, the highest ever versus sales, and it's
Wow.
just starting to roll over. So these are things that you don't get to say too much in a lifetime as a strategist. And I've only been doing this since the 80s, and only been a strategist at Bloomberg for 6, 7 years. But when you say use 100-year examples and go back 60 years and your database shows this has never happened, you have to
Right.
expect. So that to me is where we are. What you're seeing with the few latest banks are trees. Everything else is, I don't know what they're going to be, but I will say the force is burning and
Well said.
the Fed is still throwing gasoline on that fire.
Now, Mike, what you said is really well said. Let's look a year and speculate a year down the road.
Yeah.
Massive deflation. We're in a recession. You're starting to see a couple more other banks need massive liquidity. Where's gold? Is gold going to hit all
Uh,
new all-time highs?
Yeah, so to me, as we speak right now, gold has just made almost a year and a half high. It's trading almost $2,000 an ounce, 1980. I fully expect gold's going to break above $2,000 an ounce and never look back. Now, it has made new highs in terms of the euro and the yen last year, and more recently a little bit in the yen. And it's one of the most bullish type formations I've ever seen. Very bullish technically and extraordinarily bullish fundamentally. And it's been waiting for one key catalyst, for that dangling carrot of the Fed to pivot to start easing. So the key thing I
Right.
watched for gold often lately has been the Fed fund futures in 1 year. And they just started to flip from a week or two ago. They're showing in a 1 year Fed fund futures are going to be like 5.25. Now they're flipping towards 460 and dropping even more. To me, that's just the start. Markets are starting to perceive that. So everything I do is try not to focus on telling the story. Everything I do is focus on at least a year ahead. So I fully
Right.
expect Gold's going to be doing that. And one of the key catalysts, Ivan, is you notice what is crude oil. The world's most significant commodity has done one simple little thing that it almost always does. It's mean reverted back to a price of $66 a barrel. I think it was first traded in 2006. That's sign of your deflation that gives the room for the Fed to finally ease when they figure it out. And the longer they delay and the more they tighten, it's going to make that deflation worse, and the recession worse. The key thing to remember is, number one, don't fight the Fed. The Fed's still far behind on this.
Yeah, that's right.
And assets, all the leading indicators are showing severe deflation.
You know what you said so far is it rings with me, like it's spot on. And let's say Silicon Valley Bank, they get liquidity, everything's good with them in the next 2-3 months, but the Fed themselves is sitting on unrealized losses about 1.2 trillion on their 8.3 trillion bond portfolio. Is that even worse than the situation with Silicon Valley Bank, or no?
No, it's the government. The Fed can print money. I'm not worried about the Fed. I mean, if we have that kind of problem, then you might as well just add a few handles to gold. But that's the key thing that's happening. The market started to figure out. It figured out Bitcoin. It was kind of shocking that this highly risk asset is actually performing so well, up about 30% in the last few weeks. I fully expect Bitcoin to act more like the stock market, but it's trading more like gold. So no, I'm not worried about the Fed in that case, because the Fed can just monetize that. It's the Fed having to backstop all the banks. It's the thing that's happening is the difference between the Fed and the banking system. And what we're seeing in the banking system right now is, I asked myself, is how could just this be contained by just the banking system, each time picking up which one, the regulatory agencies picking up which is a problem and giving them all the money they can to depositors. I certainly hope the people guilty of poor management will be prosecuted. Unfortunately, the shareholders will get crushed. But that to me is the macro that matters, Ivan, is the Fed is still hiking rates. Now, I fully expect they're supposed to stop. But the ECB hiking 50 basis points is a sign the Fed might still go, which would be one of those final mistakes we're going to look back at from last year and said, yeah, that was the wrong thing to do at the wrong time as the world was collapsing.
Well, Mike, you said it spot on, and I want to thank you so much for coming down to Wall Street Silver, and hopefully in the next 2-3 months, as the market develops and as Powell, I think he's going to do 0.25 basis point next meeting. What do you think?
Yeah. Well, that's what the market says. The market agrees with you. I just put my WIRP function on the terminal. Let's see what it says exactly right now. 62% that he's going to go 25.
Yeah.
Applied rate's going to move up to 4.73. It shows a peak around 480 in May. Now that was 490 just a day ago, and it's been. I've never had on Monday. I think Fed funds dropped 120 basis points in the futures. So you got to watch the futures. So to me, that's classic. Going down on the elevator type stuff, and it's early days. Now the key thing to remember is, volatility in bear markets will rip your face off and take money from everybody, and have to be very careful not getting too caught up in these dead can't bounces in risk assets like the stock market, which you've already had, and copper, and things like that, and crude oil, that little bounce, and I'm like, people are like, oh, I'm like, good luck. So I look at it as until we see extreme liquidity providing from the Fed, typically takes, let's look at stock market and commodities. Typically it takes the Fed to be well into an easing cycle before these things bottom. And guess what? We're still talking about them. I just pointed out tightening this coming week. This is, and I'm afraid. I'm just hoping, trying to help warn everybody, protect yourselves and don't be too optimistic about risk assets rising.
Well, Mike, we want to thank you so much for coming down to Wall Street Silver, and then in next 2-3 months we have to have you back down, and hopefully everything you said is right and spot on.
Well, and actually, hopefully I'm wrong and we're okay. But honestly, but that's the key thing, is I have to think about, this is what I think is happening. It's a key thing I love about being Bloomberg Intelligence. I have no bias. I'm not buy side, I'm sell side, and my primary goal is get it right. And if I'm wrong, we're all better off. That's the key reason why people need to be careful if McGlone's right.
Yeah. Well, Mike, thank you again so much, and hopefully we see you in the next 2-3 months.
Thanks for having me, Ivan.
Take care.